there will never be a better wedge for them to invest into real estate as a result of everything that's happening. So when you talk about just, do you get in at the bottom or at least the downward? We're not at the top anymore. That's a fact. So if you find real estate or something or an investment that you enjoy, there will be uplift and appreciation. Like that is the time. Right now, everyone is running scared from here. You're reading it on the paper. That's when you go in.
Hey there, Adam Gower, founder of Gower Crowd here, and welcome to this week's podcast. My guest today is Eric Brody. He is founder and principal at ANAX, ANAX, and ANAX Ventures. And Eric, actually, I came across Eric, I think it was either on a LinkedIn post that he put out about a rescue venture, not a rescue fund, but some rescue capital that he's put together for real estate developers in the New York area, or it was on some publication. I can't remember where it was actually, how I came across him. But I emailed him and I asked him if he wanted to join me. And what you're going to hear from Eric today actually is a very personal story of how he came to be at the wrong end of a distressed development deal. He talks about the lessons that he learned, how he would have done it differently, and how it inspired him to set up a put together some rescue capital for other developers in a similar boat. Eric is very high energy, very knowledgeable. You're going to enjoy, and he's also like a TV star in New York, I think. He does a show with The Real Deal over there. So he talks about that a little bit as well. Now, these podcasts are available, of course, on all podcast channels, and that's possibly where you are listening to it. But we also publish them on YouTube, and YouTube has a pretty good comment section. So if you find some value in these shows, in the real estate reality show podcast, this Series 5, the Gower Crowd podcast, please go ahead and subscribe to the YouTube channel so you get automatic notifications of when new episodes show up, but also put a comment over there on YouTube in the comments underneath the video. I actually get emails notifying me whenever somebody comments, so it'd be my pleasure to respond to you and to engage in the conversation about distressed real estate, about the conversation with Eric over there on YouTube. Or, of course, you can go to gowercrowd.com to the podcast page, where you can also subscribe to our newsletter, which is hyper-focused at the moment on what's going on in the industry, on distressed real estate, and on opportunities, and how to access opportunities to invest in some of these challenge deals that we're beginning to see in the market, and the inevitable flood that we're going to see towards the end of 2023 and into 2024. All right, so let's move on without any further ado. I'm going to introduce you now to Eric Brody, who is founder and principal at ANAX and ANAX Ventures. Oh, and by the way, links to his website and to whatever other links he sends me later, you'll find that also on gowercrowd.com on the podcast page. All right, enough of that. Here he is, Eric Brody. Eric, thanks so much for joining me on the Real Estate Reality Show podcast, a brand new series. And I saw you, as I mentioned, I think on LinkedIn or possibly CRE Daily you were quoted on. And what I wanted to do was start at the very top. Let's see. So you provide much needed capital. I'm going to abbreviate this to distressed real estate projects in various stages of completion. Let's start at the very top. If you can, by using case studies or experience that you've got directly in this field, tell me, what is a distressed real estate project in construction? What does it mean to be distressed? And how does a construction project get that way?
All right, cool. Well, first, thank you. I'm excited to be on this brand new series. I feel like we should be talking about this more so that it's not just this taboo subject. We're at a time where there is distress in the marketplace. And I find that people who avoid it and stick their head in the ground, it just gets worse and worse. This is one of those things like humanity where you got to step up, you got to go into the shadows, and you got to start dealing with it. And people just didn't want to because they were hoping for a better day. Like imagine you started a development project, you make it through coronavirus, you got supply chain issues, you got, getting shut down, you don't know if your guys are going to come to work, and you get through it. And right, I always look at it, it's like you got through the cave and you finally see the light. And then when you got there, you realize you were even lower than your expectation because interest rates just went through the roof. I mean, you're fatigued now. And that is sort of where we can begin. And the story really begins as to, and I'll give you case studies, my own stress. I am a builder developer in New York for 18 years. So what's the stress? My business plan didn't go the way I underwrote it, right? There's a couple factors that occur. Forget about costs. Let's talk about interest rates, right? So distress is when you develop an asset, and whether you're by the way, this is my definition of distress as a builder developer. There's probably distress in office, industrial, and other places that I can tell you and talk to you about, but let's talk about my distress. We built the development, we completed the project, but the revenue didn't equal what you needed it to successfully refinance. So imagine I went to my investors, I gave them a business plan, and I said, hey, we're going to develop X building. It's going to be 21 stories, 50 apartments. And at the end of it, we're going to lease it up and we're going to refinance it and we're going to make this return and we're going to ride off into the sunset. Well, when interest rates go up 11 times in less than a year, whatever you underwrote or whatever your perception of the interest rate was going to be is gone. So your net operating income, the income generated by the asset, is not covering the debt service required to refinance it. In addition, banks are running away from providing loans to multifamily. So now what do? The construction loan is coming due. You need to come in with money to refinance that project. And before in the past, you would call a single if I could refinance the construction loan. Maybe you'd call a double if I refinance and pulled some equity out, triple, maybe half the equity out. And a home run and a grand slam was all the money out. You had all your equity back and you were collecting a coupon or a check for the next in perpetuity until you sold it. Right. Well, that business plan has been exploded and gone. And you would have to go back to your investors, and we call it cash and refinance. I'd have to go back to my investors. I told you were going to make money. You made it through coronavirus. Now I'm telling you, you know what? Come in with 4 times the money you actually originally invested, 10 times the original money you invested, because we have to pay down this loan or we're going to lose everything. And imagine you're an investor and you said, you know what? I'm going to cut bait. Thank you so much. I'm out the door. So the asset itself may have real value, but you can't come up with the money required because your business plan was wrong. So one type of distress is a cash in refi. And what we want to provide is that money. The asset does work. You did do the right thing. It just turns out the factors that you had, the unknown unknowns, didn't work out. So instead of them foreclosing on you, instead of them coming after your guarantees, we will come in with that money. We will step in front of your money. We will stabilize that asset and we will make it to a better day to get you your money back. So that's a cash and refinance. All right. There's other though. Let me tell you another one that we're seeing. Okay, another major one. Mm-hmm. We as builder developers, and by the way, we call Rescue Capital or White Knight Financing, White Knight Capital. We like to say it's developers helping developers. We have empathy. We are developers. Okay, we know what you're going through when you work your ass off and they get to the end and you're going to get your head cut off. And that's where we like to insert ourselves. The second one is, imagine you underwrote a deal. You got a construction loan. You're building the project. You're stopped for coronavirus. Interest rates go up. The bank says, you know what? We said we would fund you as long as you were in balance. The increased cost and the increased time, you developer need to come up with more money to keep the loan in balance, which is basically that the equity to debt ratio is what the loan covenant says. But you are a merchant developer. You don't just pour money out of your pocket. You're not that. I mean, unless you're this family and you're developing, I'm talking about merchant developers across the country, especially in New York. So now there's half-built buildings that need to be recapitalized, that need to come in with new money in order to balance the loan to get it to the end, to even execute the business plan. That's another way we're seeing distress.
So you're seeing banks actually terminating construction loan draws, are you? Partway through construction.
So banks have many levers. I don't want the audience to believe that banks can just, terminate. They have levers. So for instance, when you have a stop work order in New York City, which could happen for whatever reason, the Department of Building stops you, banks don't have to fund. So banks can stop funding a lot of times.
I see.
I think they took this as an opportunity to say, we can continue to fund this and be at risk, and we don't understand the business plan, or maybe they don't have the credibility in the developer anymore because they don't have the capital required. We could stop now, cut bait, or they can recapitalize the project and keep going. So the bank will use any opportunity to have you rebalance it because they have their own regulators, they have their own problems that they're dealing with.
Eric, that's really interesting because I've been speaking to banks here in California, and during the global financial crisis, so 15 years ago, really the last major downturn, the idea of a material adverse condition, that was the clause in contracts. Material adverse condition was used to terminate draws on projects because they had underwritten the projected value of the asset significantly lower than it had been going in. So they just stopped. They figured, no, we're not putting any more good money after this bad. And it stopped construction projects exactly the way that you're describing. But today, there is a reluctance to do that. And there seems to be less pressure from regulators, at least for the time being, to enforce banks to mark-to-market assets and to start, getting more aggressive on construction loans. Is there something particularly different about New York that is causing? I mean, you said that banks have all these levers, but it's interesting that they're actually using them. Is there something about the New York market that makes it different, perhaps, from California? I know in this context.
I think what you said is really fascinating, and I just want to take a step back. You said something called mark to market, okay? And we see it all the time when we're looking at deals. The new money that's out there has a real problem. They are looking for deals just like everyone else, but they can't underwrite the risk of the construction and development process to getting to the end. So what happens when you can't underwrite that risk? You decrease the value because you just put in contingencies here and there and there and there. You're never getting what the full value is. So I feel like in the last downturn, when they marked to market, they were getting rocked on the amount of money that they put out. Oh, it's 10 million of construction. Well, a quarter built building or an eighth of a built building is not worth $10 million. It's actually worth less than $10 million. It's not worth anything because I got to take over responsibility for what's half built. I don't know what this guy did. This is absolutely garbage, right? So you have all of these examples. So now today, the banks are like, shit, we got to get this to the end because a building that has a temporary or permanent certificate of occupancy is a marketable asset, right? So how are we going to get our money back if it's half built? We're going to take a huge haircut. So I feel like they're looking for people to come in with this capital and credibility to finish these projects so they don't get caught having to get these off their balance sheets half built when there's a hundredth of the people who actually understand what it costs to complete. So I feel like that might have changed. Do I think that New York in that respect has changed? Well, I think something that did happen. Instead of commercial lenders like the ones you talking about, and actually I have dear friends who are lenders today who are probably going out of business, whom I love very much because they were awesome construction lenders over the last couple of years for us. And I'm not even going to name them, but they're from Beverly Hills. A lot of banks started delevering right after the last crash. It was 80% finance, and then it was 60%, and all this credit enhancement. So there was a new lender in town, sort of all of these secondary lenders or these debt fund lenders, right? Many of those debt fund lenders had in-house sort of construction and development teams, right? So maybe they're a little bit reluctant because they're like, worst case, we got to take this over and finish it. I believe that could be a bluff in that if you're really going to take over all your loans and finish those projects, really you're a developer builder. You're not really a lender. So it'll be a slippery slope, but maybe that's why they're just holding on longer, is that they're trying to determine if they should be the ones to take over and complete this project.
It's funny you should say that, actually, because it does sound a little, when I have these discussions with bankers, it does sound a little like kicking the can down the road in the hopes that things will turn around, and that's, I didn't see that during the global financial crisis. Actually, I saw a hard stop to lending. This time there seems to be a reticence to take back assets or to sell notes, etc. Because there's a sense that things will turn around and that it will get better, perhaps because next year's an election year. I don't know. or the Fed will reverse course. And as soon as that happens, there'll be an explosion of investment. Everyone's going to want to get in before they miss out, right, on all the discounted real estate. But actually, let me just shift track a little bit here. So,
but by the way, I just wanted to say to you, I feel like real estate in New York and our major cities is fatigued. There needs to be a reset valuation. It's been death by 1,000 cuts. How many more cuts can we take? I think the interest rates are going to go up again. And people are just like, all right, like finally we realized more time, it's not going in our favor. It actually seems in sort of this midterm, it's going to get worse. And people are like, you got to cut bait, which is why you're seeing these massive funds, massive companies just like, you know what, our equity's out, take it. Like we're out, right? So I think you're seeing that in development as well, where they're like, what's our pathway to getting back any of our equity? And the answer is none. And they're like, fine, we're out. Good luck.
Yeah, it's really interesting you say that, that this is that the industry, commercial real estate industry as a whole, needs a reset in pricing. It's very interesting that you say that, because you don't read it with the Fed and what they say. They don't articulate it. But I wonder if that isn't a conscious decision, or in part is to slam the brakes, particularly on the real estate industry, because that's where so much wealth, so much money does reside. To slam the brakes on that is what will. It's almost as though the real estate industry are the brakes of the economy. And once that grinds to a halt, then you can start up the engines again.
Because correct, and it doesn't seem politically. And it doesn't seem politically anyone has the will to save them. Like
you can't say that. Right? It's never been. You can't say that's what you want to do. But I don't know if it's. There's a few things that have happened historically with the SEC and regulations, etc., that were never actually overtly intended for commercial real estate. Securities Act, 1933, Jobs Act, 2012. They were never intended for the real estate, but real estate was one of the what's it called, the unintended consequence. Yes. 33. It was the opposite of beneficiary. In 2012 it was beneficial, but that's a whole different story. And I totally agree with you. I think there's going to be a reset, and I think it's a not necessarily conscious, but an unspoken.
And for us, look,
the interest rate hikes.
And for us, that was the opportunity that we identified. You asked me like kind of why you did it. It was like, you know what? These assets are of incredible value. The developers, unfortunately, have just in the circumstances have just gotten rocked. So we can come in with that capital. I think that there'll be a reset valuation. And we also believe that we can restructure the deal so that these principal developers actually do get something out of it while saving the banks as well.
So I love it. You perfect segue into my next question, Eric. I'm really glad you did that. So You set up for ANAX exactly a year ago. So I noticed May 2022. So a year ago. Happy birthday. This is a rescue.
By the way, we set up like the incorporation of it, that was like, we just really, and we'll get into the timeline right now,
But perfect timing. It's interesting that you would have chosen that time. It was very fast. You're obviously fast off the mark for that. So, but this is a rescue capital fund. I'm putting words into your mouth, but I think that you've
not a fund. We call it a venture.
A venture, rescue, but it's rescue capital. So what are talk to me about the like you talked about, what did you say? Harsh reality. I forgot the exact term you used.
Me neither. Don't worry. I forgot also.
What are the economics you're looking for? So give me an example of like the ideal scenario for a deal that you will bring rescue capital into. And then I have some questions about where you get that.
Sure.
Let's start with an ideal scenario.
I think what's important for the audience to know, right? And we're talking to investors and developers, is none of this conversation is recreating the wheel, right? If you think about who are investors, sovereign wealth, private equity, hedge funds, right? They're all looking for a specific return. And I believe it was Blackstone or BlackRock, we just heard, raised all this money at 12%. They promise their investors 12%, and they must be getting better deals than the rest of us. So I think most important is to just understand what is capital stating the return they need on their money. And it seems to be coming in at this, we're looking for these high teen IRRs. we're looking for multiples on our equity, right? So you're plugging that into any deal. It doesn't matter because that's the capital that is interested. That's that dry powder on the sidelines is this type of capital or wealthy individuals. And they're all saying the same thing, these high teen returns. So no matter what, you're looking to achieve a high teen return and then you're basically structuring it, right? Let's say it's a half-built building. So you're basically underwriting that asset to complete that construction and development to then achieve these metrics, right? So what's the arbitrage? You should be building to something over a 7 cap, which should be your, your build to stabilized rate. And then in 5 years, you're hoping that the cap rate compression is there and you're getting to this 18, high teen IRR return. And they're all looking at it that way. So when you're underwriting or you are in distress or you have an asset, new capital is going to request that. That's it. And it's whether pay current or it's on the back end and then a split with you or however you then structure it is where it gets, more creative.
So if you're underwriting to a 7 cap, and that's just part of
build to cap rate.
Yeah, underwriting to a build to 7 cap. Are numbers making sense on deals that you're seeing with the existing debt that's still on the property? Because you still have to take over that first position loan still has to stay in place, doesn't it? Or at least, or be paid off or whatever. I mean, there's some heavyweight debt already sitting on these properties. Are you able to?
Yeah, so they're tri-party agreements, and the answer is no, right? Imagine, and I can only talk about New York because that's where we are located and working. The business plan or New York's land values were predicated on condominiums when you're talking about multifamily. So the highest and best use for that asset was a condominium, and that's how the landowner was selling that land. So all of your metrics and the way that you underwrote it was to do a certain plan. That plan is not necessarily working. When interest rates went higher, you're extending absorption rates on condominiums. It's like, I don't want to take that risk. I got to convert it to a multifamily rental asset. And when that happens, yes, everyone, and you have to have a creative structure with the senior as well, because you need them to stay in the deal, just like you said. You can't put mez on it because they're already having trouble with the developer. And they've already probably made attempts to say that you have already, triggered some type of either recourse or, some type of, default or whatever it is. So you have to bring in preferred equity. They need that fresh capital to get their money back. So we're also looking to restructure with the senior as well.
So you are, can I just understand this right? So rescue capital is in your world synonymous with pref equity, is it? It's pref equity.
Or it could be mez or stretch senior. But yes, rescue capital is basically recapitalizing the asset and either inserting yourself as preferred equity in front of the existing equity and restructuring with the senior. That's what we're seeing right now.
And you have, are your developers, are you actually discussing terms with developer lenders as well, with your prospective developer lenders? You get involved in discussions, but how does that work?
Well, that's so for us, we have a unique position. We have 3 advantages that others don't. So the first one is proprietary, and that's we are so deep into technology. We started venture funds. We understand the way in which technology is changing our game. We use our technologists to bring in tons of deals for us, which makes us sort of like Iron Man. Like we are, if everything has a digital footprint, we know that you are out there. So our deal flow is tremendous. The second is most capital cannot underwrite development and construction risk. They can't handle what that risk would actually be. And then the third one is that you can incorporate technologies to increase NOI and ROI. So for us, it's a hands-on approach. We may know the subcontractor who failed on you and be able to structure that deal when you get into the nuance of construction and development in New York. It's like you need to stand on the shoulders of giants. You need to have a competitive advantage over a capital that's out there. And for us, it's that we understand the nuance of the way that you can build and develop and stabilize and market in New York City. So for us, I'm not saying for tons of rescue capital out there, they may have separate advantages. For us, those are our advantage. So we're just playing to our strengths in that regard.
Yeah, and I would actually encourage anybody listening or watching to go to Eric's LinkedIn profile. He actually has, you have actually very good posting on LinkedIn.
Thank you.
Kudos to you. And he does talk about tech a lot. In fact, that's a kind of dominant theme. So I'll put that.
Well, tech and also The Real Deal, which you may have heard of The Real Deal, which is a real estate publication. We have a TV show on construction and development, right? So we try to create content talking about construction and development and talking about the issues today in technology. And that's a different strategy about creating content like you're doing.
So on the so on the podcast page anyway, on GowerCrowd.com, you'll find a link to Eric's LinkedIn page. I do suggest you go there, take a look at him. There'll also be linked to his whatever he sends me. What they talk to, he's going to send me a whole page of links probably. Now you mentioned this a couple of times. We should move towards wrapping up. It's like incredibly fast these days. I would. You said don't go longer than half an hour because everyone will fall asleep. I do doubt that. And I would love to go a bit longer, but just give me a few more minutes here anyway.
Sure.
So one of the things that you have alluded to or mentioned a few times, and you've said it quite subtly, but let's get real. This is the real estate reality show after all. You've talked about coming in front of existing investors. What does that mean exactly?
Yeah. So first and foremost, I think it's super important that people understand the consequence when we're like, you have a distressed asset. What that means. Developers have signed on for certain guarantees, recourse, non-recourse. If you really understood what's in a developer's stomach and what they can handle, they're taking on a lot of risk. And I have empathy for that because I was a builder developer. So they collected this money and they put it in a deal where it's, let's say, a construction loan. Maybe there's measure pref and then common equity. Okay. When you reset the value, unfortunately, that common equity has to turn into a hope note, a hope in the future that they can get their money back because the new money has to get their return. So you're stepping in front of them, taking that responsibility, getting your return on your money, and then hoping that the compressed cap rate of the future sale will pay them back their equity and upside. But these are facts. Their equity may be out. You're reading that in front page news where you're seeing these massive commercial builders and developers giving the keys back. Why are they giving keys back? Because they don't see a pathway to getting their equity back. Right? This is, let's call a spade a spade. You're probably out when interest rates go up 11 times in a year. Like your NOI is not creating and cap rates are expanding. Like, where do you see this happening? What we're saying is rescue capital is going to allow you to punt instead of 1 year or 2 years, 5 years. Let's get us out into this new world and then see what happens.
Yeah, interesting. All right. So let me ask you 3 more questions.
Sure.
And please spend as long as you want answering each of them. I don't pay heed to the clock. So you talked about your case study, your first case study, gave me an example. It sounded like it was a personal experience, a deal that you had actually worked on. So that must be very stressful. Just going back to when you put that deal together, it's an important question. What would you have done different? If you knew exactly what was going to happen today with interest rates, then when you originally underwrote the deal and you were the only person to know that, how would you have underwritten the deal differently? And would of pencil, would it have actually happened if you'd done it that way?
By the way, it's a great question because it got me into the tech space. Bank gave me the money. Investors gave me the money. Okay. I did the deal, right? I sounded good. Economics worked.
Right.
When I checked the data analytics, and it reminds me of like Cambridge Analytica, the 2016 election, it's like, if you had the data, I would have known that there was way too much supply and that the rate of absorption of those units was so slow that if I divided the rate of absorption by the future supply, it was like 9 years of product coming out. So forget about interest rates going up, forget about anything. I never would have done the deal. You didn't have the data required to make that decision making. That will never happen again. I invest in data analytics companies and other companies that give me that information. So if you would have known that it wouldn't underwrite, you'd be what I like to call a schmuck to have moved forward. You should have walked away and figured out a different place where you had an advantage in order to develop that asset. So I would have walked. You think I want to have gotten into a place where you're, you got people coming after you, and it's awful, right? So for me, that's why I have empathy in the game and doing this. It's like, no, you don't have to go through what I did. We can figure this out, right? But you just have to be real with yourself. I stuck my head in the sand and it didn't work. And that was sort of the kernel of what came to today, right? You look at the worst moments in your life. And if you always look at them and say, oh my God, what was me? But it's that lesson that you learned. It's a hard pill to swallow. But the reality would have been, I would have walked, never would have done it. If it doesn't pencil out, it's like watching yourself go into like a brick wall slowly where you're going to get smushed.
I deeply sympathize with you and also admire you very much for pulling yourself up by your bootstraps. Isn't that like they call it? It's very tough.
100%. You look into your shadow and you come out of it and it's different, right? And as long as you're willing to do it, right?
So let's wrap up. A couple of questions then. One, I'm
Sure.
going to ask all of my guests on this show. But this one, before we get to that, is so you put, and I haven't called it a fund. What do you call it? A rescue?
It's a venture because
A venture.
you got capital behind you that's
Right.
saying we're interested in programmatically funding you,
Ah.
right? But it's just one or two sources. It's not as if I had to file and
Ah.
go to 1,000 people. It's just two funds that back me. Boom.
Got it. Okay.
So that's why I don't call it a fund, because a fund has all of these other rules, and it's a venture. You create a joint venture, and you move forward in that regard.
All right, got it. So that actually what you preempted my question, and that was, where is the capital coming from? So you're not looking at individual accredited or high net worth individuals, investors, to help capitalize your venture. You've got two programmatic financiers, I suppose, maybe that's the right one, or investors. But have you seen rescue funds elsewhere that are inviting accredited investors and individuals into them?
They're just, look, everyone is raising somewhat differently. One of the things I learned from the past was we used to hold out the hat to friends and family to raise capital. And when Corona hit and we needed capital, they were like, doctors, and they didn't know if they were going to survive. They were seeing what was happening in the rest of it. So you kind of have to learn from your mistakes. So for us, we just wanted to go with just a larger sort of pocketbook of capital. There are other opportunities, though, for accredited investors. I don't want to say no. There's other structures and other ways of them getting involved into this business as well. We just think that when you have the major money behind you, you get a lot of their credibility, the way in which they look at it, and they can move quickly. When you're going out each time too, it's just a little bit less efficient. Doesn't mean you can't get it done. It's just a little bit less efficient. Takes more time.
Right. You are like the perfect guest, because each time you say something, it tees up my next question perfectly. Segues into it. It's my last question. So my last question, this is something that I am going to ask all of my guests. What advice to accredited investors or to passive investors, right? Not professional investors, who are looking at the commercial real estate landscape today? What advice, and wanting to invest, right? They want to, forgive me for saying it, but they want to find opportunities in this term.
Yeah, they need access. I get it.
What advice would you give them as we move deeper and deeper into what is a commercial real estate downturn?
I think first and foremost it is not that complex. If somehow you're talking to someone and you can't understand it, where they're keeping it simple, stupid, like, walk away. It should not be that complex. It should be simple. Real estate is somewhat simple. I'd be a doctor, a lawyer, maybe some other profession. Otherwise, I'm here, right? And it's like, break it down and make it simpler for me. Like, it doesn't. I know some guys in New York that you would never know about how much they own, and you'd say, like, it just kept it simple. So if it's complex, forget it. If you're going to get wonky with it and you can't break it down in like a 30-second pitch as to what it is, walk away. Second thing is, you always invest in the person. Okay. At the end of the day, it's credibility, which is a combination of expertise and trustworthiness. Expertise, you need to ask them, like, what have you done? And like, why do you know what's going on? Trustworthiness is a different story, because if they tell you you should trust me, don't trust them. So there has to be some innate ability to understand whether somebody is actually trustworthy. So make it simple, keep it simple. The second thing is that they should be credible, which includes their expertise and trustworthiness. Like, let's stop making everything so damn complicated. And if it makes sense to you, and you are an entrepreneur, you were into widgets or whatever you did, and you can relate what business you were in and the skills required for someone that you look in, invest in that person, and that's where it will be. And then just the last thing, by the way, on a macro scale, there will never be a better wedge for them to invest into real estate as a result of everything that's happening. So when you talk about just, do you get in at the bottom or at least the downward? We're not at the top anymore. That's a fact. So if you find real estate or something or an investment that you enjoy, there will be uplift and appreciation. Like, that is the time. Right now, everyone is running scared from here. You're reading it on the paper. That's when you go in.
Eric Brody, what an enormous pleasure to meet you. Founder and principal at ANAX and ANAX Ventures. Thank you for joining me.
And just don't forget, I'm sending you all the links for everybody.
An entire page of links with do follow links. I know what he's going to send me. It's all right. I'll give you everything you want. We have very good DR ratings, so don't worry about it. It's my pleasure.
And you're amazing. I totally appreciate being on it. I wish there were more people like you out there. We should be having this discussion, and it's really important. So thank you so much.
No, Eric, please don't stop.
All right, brother, man. I'll talk to you.
All right, that was, as you just heard, Eric Brody of ANAX and ANAX Ventures. He is specializing in raising some rescue capital from some individual programmatic investors. So not open to individual investors, but we will be talking to other people that have rescue funds that inevitably will be open to individual investors. So stay tuned for those. As I mentioned at the beginning, these podcasts are published on YouTube. So please go ahead and subscribe on both channels, both on whatever is your favorite podcast channel, as well as on YouTube, so you get immediate notification when they come out. And on YouTube, I really would appreciate it. I'd love to engage in a conversation with you about these thought-provoking podcasts about this very intense period of real estate investing that we are slowly moving. Inevitably, it's going to build to a crescendo. So go ahead and leave a comment there on YouTube if you get the chance. And I'll do my very best to get back to you as soon as I possibly can. Again, thank you, Eric Brody, over there at ANAX. It was a real pleasure to meet you. I really enjoyed our conversation. I'd love to stay in touch. And thank you, dear listeners, and of course, viewers, if you are there on YouTube. Thanks for joining us today. I hope you found today's conversation of value and helpful to you as you navigate these turbulent waters. That is it for this episode. I'll see you next time. And for now, this is Adam Gower signing off.